Opening a stocks and shares ISA is by far one of the best things that you can potentially do when building a life of financial freedom. However, there are some really important things that you must know before you open your account, and in today's video I'm going to be going through every single one of them. But before I do that, let me just give a quick explanation as to what a stocks and shares ISA is for those that don't actually know. So basically, a stocks and shares ISA is an account that you can open up with most stockbrokers that actually allows you to invest up to £20,000 every single tax year, and the money that you make within that account, whether that be from capital gains or dividend income, is going to be completely tax-free. One thing to remember about the stocks and shares ISA is that if you do own any other ISAs, such as a cash ISA with your bank, then the money that you put towards both of these are going to count towards your £20,000 limit. It is not separated within the different accounts that you create. But all in all, a stocks and shares ISA is a great way to invest into the stock market without having to worry about the taxman coming to knock on your door to take money away from your hard-earned capital gains and dividend income. So having cleared all of that up, let's now jump into 5 secrets that you must know before opening up a stocks and shares ISA. Number 1, they are not flexible like normal ISAs. Okay, so let's say you have a standard cash ISA and that is it, and within that tax year you have decided to invest £20,000 into that cash ISA, which is the limit at the moment. And let's say a couple of months before the tax year ended, you decided to take out £5,000 to spend on something for yourself. Now, what would actually happen here is that your total contributions to your ISA would be a net contribution of £15,000. You would then be able to, before the tax deadline reaches, invest a further £5,000 back into your ISA to be able to make up to that £20,000 limit. This is what is classed as a flexible ISA. However, with most stocks and shares ISAs, these are not flexible. So if you were to invest that £20,000 and you were to take £5,000 out of your stocks and shares ISA, your net contributions would still be £20,000 and you would not be able to add any more tax-free money into your ISA. If you did want to carry on investing, however, what you would actually have to do is, number 1, either wait for the new tax year to start and then invest your money back into your ISA when the limit resets, or number 2 is actually open up a general investing account with your current stockbroker, but this means you would then be liable to capital gains tax potentially. Number 2, your remaining allowance cannot be carried forward to the next year. Pretty self-explanatory this one to me, but basically if you are unable to take advantage of the £20,000 a year limit, what doesn't happen is that the remaining amount that you are unable to invest every year does not get carried forward to the next year. So for example, if you were to invest £15,000 in one year, you wouldn't have an extra £5,000, meaning your limit for the next year is £25,000. It simply just gets reset to £20,000 every single year, whether you are able to max it out or not. The only way that the £20,000 a year limit will get changed is if our government decide to up it in the future, and given its track record in terms of increases, this is very likely to happen. I remember when I first opened my first ever ISA, the limit was actually only £12,500, and in around 9 years since I did that, it has now gone up to £20,000, so expect in the future for this number to raise. Number 3, whilst you do not have to pay any taxes, you will have to pay some fees. This is the one thing that I believe people forget about the most when it comes to opening a stocks and shares ISA, and whilst these fees are only going to be a small imprint on your money in the long run, I think it is still really important to know exactly where all of your money is going. These fees will be completely dependent on the funds and shares that you decide to invest into, and also the type of ISA provider that you choose to go with in the first place. Some of the common ones that you will come across is the annual fee. This is simply an annual fee that you will either pay as a set amount or a percentage of your investments to your ISA provider as a commission for looking after your account. The second one is dealing charges. So when you buy a stock, you could be potentially paying commission to your stockbroker. You also have things like US and UK stamp duty that you will pay when buying stocks. And then if you are investing into stocks with a different currency, there will be a foreign exchange fee that you will have to pay as well. For example, here is a real copy of a purchase note for 55 Apple shares I bought last year. As you can see, I paid £11.95 in commission fees and £51.62 in foreign exchange fees. Of course, this is an investment of over £5,000 in one go, so if you do invest smaller amounts, you will obviously not get charged as much, but this is all still very relative. And if you did want to save as much as possible on commission fees and things like that, then I highly suggest checking out FreeTrade, which is a commission-free trading platform. And if you were to actually use the link in my description down below to sign up, deposit £1 onto the platform, you will actually receive a free share worth anything between £3 and £200. So if you do get the time, please make sure you go and check that out. Just going back to the additional charges, if you decide to invest into what is called an actively managed fund, which is where basically someone is going to be buying and selling shares for you on a daily, weekly and monthly basis, you will have to pay a management fee on a fund like this. And then the final fee that you may have to pay is something what is called an exit fee. This is simply a fee that you would have to pay if you decided to transfer your money from one stockbroker to another. This all very much depends on the stockbroker that you are going with. Some offer a completely free transfer, but some do charge what is called an exit fee. Number 4, your dividends are not automatically reinvested. Now, once again, this is very much dependent on the stocks and shares ISA that you choose to go with, but most of them out there do not offer automatic reinvestments of your dividend payments into your stock. So what you are technically going to have to do is constantly check your stocks and shares ISA to see if you have been paid any dividends, and then if that is the case, you will have to manually reinvest those investments yourself. What's going to happen if you don't decide to manually reinvest your dividends? Well, all your money is simply going to sit in a cash section of your ISA, and with it sitting in that section, it's not actually going to be earning any interest, which kind of goes against the entire point of opening a stocks and shares ISA in the first place. Fortunately for myself, when it comes to my own personal stocks and shares ISA, there is actually an option that allows me to automatically reinvest, but once again, like I said, this depends on the broker of your choice. This isn't a sign to go ahead and sign up with the same stocks and shares ISA that I use. This is simply one of the benefits they offer, and every single stocks and shares ISA offer different benefits in different areas. Number 5, stock splits on fractional shares. Right, before I get into this one, let me quickly explain these two terms. Number 1, fractional shares. So basically, if you are using a investment platform like FreeTrade or Trading 212, they actually allow you to invest fractional shares into a company. So basically what this means is, let's say Apple's share price is currently $150, but you only have $75 to invest. You can still go ahead and invest into Apple stock. However, you will receive only 0.5 of that stock. This is what is classed as a fractional share, and this is normally used within beginner investors that don't quite have the capital to invest into those more expensive companies. A stock split, however, is a decision that a company's board of directors decides to make to be able to offer more shares to its stakeholders without diluting the current value of their stakes. For example, last September, Apple actually decided to do a 4-to-1 split of their shares when it reached a value of around $400. At the time, I actually owned 10 shares of Apple, and after the split, I actually then owned 40 shares of Apple with the value of around $100. Nothing changed at all in terms of the value of my shares. What Apple basically wanted to do was make their stock more accessible to newer investors. So let's now talk about fractional shares and stock splits, and I'll be honest with you, it's a little bit rubbish. So basically, with fractional shares, when a stock split occurs, you will not see any benefit on the fractions that you own of that stock. Instead, what will happen on the date and time of the stock split, you will actually get paid back out your fractional shares in the form of cash into your ISA account. Just for example, let's say you own 2.5 shares of Apple stock and they decided to go ahead with the 4-to-1 stock split. What you wouldn't have is 10 shares of Apple stock, which would be 4 times 2.5. What you would actually have is 8 shares of Apple stock, because that is the whole number that you have in Apple shares, and the remaining 0.5 shares that you did have with Apple stock would get paid back into your ISA account as cash, and then you can make a decision whether you either want to reinvest into something else or reinvest that back into Apple stock at its new share price. The good thing, however, stock splits like this aren't something that happens on a regular basis, and when this is going to happen, you are normally warned way ahead of time, so it gives you plenty of time to be able to get your investments in place. So there are 5 key things that you need to know before opening up your stocks and shares ISA. As I mentioned in the video, if you haven't checked out FreeTrade already, make sure you click the link down in the description down below and go and claim your free share worth up to £200 in value. Other than that, hit a like on the video if you did find it valuable, and I will catch you guys in the next one.